Something strange is happening behind closed doors. While the public chases headlines, central banks around the world are moving with urgency, not away from risk, but toward gold. Quietly, relentlessly, and on a scale that hasn't been seen in over half a century. This isn't a one-off anomaly. It's a trend accelerating in real time. In the past 3 years, global central banks have bought over 3,000 tons of gold. Just in 2024, they purchased 1,044 tons, making it the third consecutive year above the 1,000-ton mark. These are not investor flows. This is institutional hoarding by the very entities that issue currency. So what are they preparing for? The gold price recently broke through $3,380 per ounce, setting a new all-time high. That's a 25% surge this year alone. Traders point to inflation, rate uncertainty, and geopolitical stress. But central banks don't chase headlines. They respond to structural threats. Let's take a closer look at what they're actually doing. India's Reserve Bank now holds over 879 tons of gold. That's up 30% since 2020. Poland, long overlooked, led global buying in 2024, adding 90 tons to its reserves. Even smaller states like Singapore and the Czech Republic have quietly grown their holdings by double digits. The World Gold Council's latest survey revealed something stunning. 95% of central banks expect global gold holdings to rise, and 43% expect their own gold reserves to increase in the next year. This is not a coincidence. Across the board, central banks are opting out of the fiat system they helped create, not through speeches, but through silent accumulation. And they're not doing it with ETFs or futures. They're taking delivery, physical gold, vaulted, verified, sovereign-controlled, and off-grid. This isn't about price speculation. It's about sovereignty, liquidity, insurance against a broken monetary order. Because under the surface, faith in the U.S. dollar is eroding. The U.S. national debt is now above $35.8 trillion. Interest on that debt is projected to exceed defense spending within 2 years. Foreign holdings of U.S. treasuries have dropped by hundreds of billions since 2021. China has trimmed its U.S. debt exposure by nearly $300 billion. Japan has slowed its treasury buying. And the BRICS nations, Brazil, Russia, India, China, and South Africa, have openly discussed a new reserve system backed by commodities, including gold. Now let's introduce a deeper question. What if these gold purchases are not a diversification play, but an exit strategy? When institutions fear a system breakdown, they don't advertise it. They rotate assets quietly. They rebalance risk in silence. And gold, more than any other asset, is silent. It doesn't default. It doesn't depend on an internet connection, and it can be held outside the banking system. The global financial system is still based on trust, but trust is eroding, and central banks are hedging accordingly. Here's the midpoint reset. For decades, gold was mocked by mainstream economists. It doesn't yield. It's a barbarous relic. It has no place in a modern portfolio. That was the narrative. But now the world's most powerful monetary authorities are reversing course. They're voting with billions. And they're buying the very asset they once dismissed. That should make you pause. Why are the architects of fiat returning to the hardest money known to man? Let's dig deeper. The Bank for International Settlements, the central bank of central banks, recently adjusted capital treatment for gold held by member banks. For the first time, allocated physical gold now receives near risk-free treatment on balance sheets. This is a signal. Gold is being remonetized. And the BIS isn't alone. Basel III regulations quietly favor physical gold over paper contracts. That's why central banks are not just investing, they're upgrading the quality of their reserves, moving from unallocated to allocated, from exposure to possession. Now here's your stat hook. Total official gold reserves are approaching 36,000 tons, the highest since 1965. That's not theory. That's a fact. We are now at a level of sovereign gold accumulation not seen since the Bretton Woods era. And it's not just central banks. Institutional investors are following. The SPDR Gold Trust, one of the largest gold ETFs, now holds over 946 tons of gold. Major hedge funds have reopened gold positions at multi-billion-dollar scale. Even sovereign wealth funds from the Middle East are taking delivery through Swiss and Singaporean vaults. This isn't panic. It's positioning. Now let's open the emotional lens. If these institutions truly believed in the current system's long-term stability, would they be shifting into metal? If fiat was a final form of money, why go back to gold? What they see is fragmentation, multipolar finance, sanctions as weapons, banking infrastructure as leverage. And gold exists beyond all that. It doesn't care about SWIFT. It doesn't care about sanctions. It doesn't vanish in a power outage. It simply holds value everywhere, always. Here's where the tension tightens. The next crisis won't be announced in advance. It will arrive through volatility, through policy error, or through black swan. In that moment, liquidity dries up. Panic sets in. Trust evaporates. And that's when the gold vaults open, not for sale, but for collateral. Gold will be used to settle debts between nations, to backstop currencies, to signal credibility when fiat is in question. The public won't see it coming, but institutions already have. This is the silent bank run, not out of banks, but out of the monetary system itself. And here's your final insight. You don't need to be a central bank to think like one. Ask yourself, why are they buying metal, not digital assets? Why are they taking delivery, not speculating on ETFs? Why now? Because they understand the cycle. They know how monetary systems break. They know what holds value when confidence cracks. The real question isn't why gold is rising. It's why the world's most powerful institutions believe they'll need it. Subscribe now for more signals that matter. Because for the first time in decades, even the elite aren't sure the current system will hold. And when the foundation of global finance begins to shake, those closest to the epicenter don't wait for confirmation. They move quietly, they act early, and they prepare while everyone else is distracted. You won't see these headlines splashed across mainstream media. You won't hear it from political podiums. But behind the curtain, the signals are clear. There is a global rebalancing underway, one where hard assets are being favored over promises, where physical control outweighs paper exposure, and where trust is no longer automatic. This shift won't happen in a single day. It will unfold in layers, slowly at first, then all at once. As currencies lose purchasing power and sovereign debt climbs beyond sustainable levels, gold will reemerge not just as a hedge, but as a reference point, a recalibration tool for a system that has stretched too far, too fast. Already, new trade agreements between countries like Russia and China are being settled outside the dollar. Some include gold convertible payment options. This isn't theory, it's emotion. And while the average investor debates meme stocks and interest rates, central banks are locking in metal. That should tell you everything. Because if gold truly had no role in a modern system, why are the most powerful institutions going all in? They're not speculating. They're signaling. And that signal is getting louder. So here's a final takeaway. The silent global bank run is not about panic. It's about positioning. It's about a slow strategic rotation out of paper systems and into permanent value. It's about preparing for a future where trust may be earned, not assumed. And in that future, gold won't just be insurance, it will be influence. Subscribe now for more signals that matter. This shift also explains why we're seeing a quiet revival of sovereign minting programs. Nations are not just accumulating gold, they're preparing to use it again as a visible display of trust, independence, and economic resilience. Whether through gold-backed bonds, settlement agreements, or reserves in regional trade blocs, the direction is clear. Gold is no longer a relic. It's becoming the reference point. And those who recognize it early will not just preserve wealth, they'll inherit influence. Subscribe now for more signals that matter.